A very good evening, friends. So nice weather, and today we've got a very interesting topic, and at the same time, a very important topic as well from the examination point of view. I would say that, that invariably you definitely get a question in the exams, and that topic is financial instruments. And I think it's one of the very interesting topic and also forms one of the core important topics as far as the Indian accounting standards are concerned. Because I think unless we get a knowledge on financial instruments, it's very difficult to apply a lot of standards as well. So we're going to spend a good time on financial instruments. Almost we're going to devote a total of 10 classes with you. And this will give you a good exposure and understanding of the standard as well. No worries. I think first of all, I'd like to give you a comfort that I'm not assuming any kind of base on your part. But of course, at the same time, I have certain expectations from you. Though I'm not assuming that you got any base, we'll start with the standard from the very scratch itself. But at the same time, there is an expectation, and that expectation is in terms of a cumulative revision. In the sense that today, after the first class is over, you're going to certainly revise this particular class. Then once the second class is done, I expect that you will quickly revise the first two classes. Then once the third class takes place, you're going to quickly make revisions of all the three classes. And so on. And by the end, we are done with all the 10 classes. I would say that you should do a consolidated revision and then try to practice as many questions as you want on financial instruments. So let's, I think, begin the journey on the topic on financial instruments from the very scratch itself. So once again, a very good evening to all of you once again. And I think let's begin the journey. Well, I think the very first question what comes to the mind is what is financial instruments? But before I give you exposure on what is financial instruments, let's first of all tell you which accounting standards, which Ind AS deals with the subject of financial instruments. So when we're looking at financial instruments, there is FI. There are a total of 3 standards as far as financial instruments are concerned. So there are 3 standards which are devoted to financial instruments. One is Ind AS 32, what we're going to start today. And the name of the standard Ind AS 32 is Financial Instruments Presentation. So the aspect Ind AS 32 deals with is called presentation. And I think at this stage, let me also tell you that when we're looking in terms of presentation, we're looking in terms of presentation in the balance sheet of a company. When you make your financial statements, one is a profit and loss statement and one is a balance sheet. The focus in terms of the presentation, just to give you a reference, presentation in the balance sheet of a company. Next, the second standard which talks about financial instruments is Ind AS 109. And the name of the standard Ind AS 109 is also financial instruments, but it is called recognition and measurement. It is called recognition and measurement. So this is one standard which is talking in terms of pure accounting treatment. So as the name is suggestive that it is measurement, so you're going to learn the core accounting aspect in terms of the standard. So I would say if I'm looking at Ind AS 109, the focus is going to be mainly, you can say, on the core accounting of this instrument. And then there is another standard as well, and that is Ind AS 107. That is called Ind AS 107. And the name of this standard is also financial instruments, but it deals with what we call disclosures. So the name of the standard is Financial Instruments Disclosures. And of course, when you're looking in terms of disclosures, these disclosures would be, of course, at, you can say, notes to accounts. Like when you're looking at the presentation is with reference to the balance sheet, and we're looking at the measurement, the pure accounting, and the disclosures would be in the notes to accounts. Now, considering the examination perspective, the focus, of course, will be mainly in terms of Ind AS 32 and in terms of Ind AS 109. We're not focusing in terms of Ind AS 107 from the examination perspective. So my focus, of course, will be on Ind AS 32, followed by Ind AS 109. So that was just to give you a very basic input, and you can well imagine that if there are three standards devoted to the concept of financial instruments, you can well imagine the kind of intensity the topic would have. If one standard was not enough in order to capture the entire concept, and the accounting standard board had to actually devote three standards to the area, naturally the level of complexity increases. But trust me, when the complexities increases, so also is the interesting inputs increases. Okay, now with this inputs in hand, let's, I think, first of all, get to the first agenda, that what is financial instrument? Now, before I take you to the definition of financial instruments, I would like to give you a little background so that before we read the definition of what is financial instruments, we are able to understand it a little better. So before we read the definition, let me explain in simple words what is a financial instrument. So when I'm looking at a financial instrument, let's, I think, take a simple example to understand this. Now, let's say, for example, there is a company ABC Limited. So let's say, for example, there is a company ABC Limited, and this company, let's say, issues debentures, for example. Or let's say this company issues, let's say, shares for that matter. Now, when a company ABC issues a debenture, or we can say when it issues a shares, we can say they've issued an instrument. So when does it become a financial instrument? We'll see. But we can say that they are basically issuing an instrument, and the thought process is we need to decide that is this instrument supposed to be equity in the balance sheet of the company, or is this instrument going to be presented as a liability in the balance sheet of the company? Now, if you recall, on the liability side of the balance sheet, we always present equity and liability. So when we present equity and liability, equity basically means own funds and liability basically means the loan funds. So when a company issues an instrument, whether it is a debenture or whether it is a shares, you need to take a call and decide that is it supposed to be own funds and I present it in the balance sheet as equity, or is it supposed to be a loan fund and I present it in the balance sheet as a liability? And to be more specific, we're going to use the word not liability, but we're going to use the word called financial liability. So in this particular case, we are focusing that when a company issues an instrument, it needs to decide the presentation in the balance sheet. That is this instrument going to be reflected as an own funds that is equity, or is it a loan funds that is what is technically called a financial liability? Now, one or two more things. Now, in my example, if I were to say that who is ABC, I would say he is the issuer. He is the issuer of the instrument. The company which issues the instrument is supposed to be called as the issuer. Now, these instruments would, of course, be, invested by other companies. So let's say, for example, the company XYZ makes an investment in these instruments. So we can say, let's say, for example, ABC issued these instruments, then ABC became an issuer. And another company made investments in these instruments, and we can technically call this company as a holder. Like, for example, you can say you issued the debenture. So the people who subscribe for the debentures are called the debenture holder. The company issued shares, and the people who subscribe for the shares are called the shareholders of the company. So all those who made investments in these instruments are going to be called as holder, and they are going to show it in the balance sheet as an asset. They're going to show this in the balance sheet as an asset. And to be very precise, if I call this, they are going to call this assets as what we call financial assets. Now, don't get worried on what is a financial liability or what is a financial asset. I'm just saying that instead of calling it as an asset, they're going to specifically say that it is a financial asset. Instead of saying that it's a liability, they're specifically going to call it as a financial liability. So I think let's take a consolidated view. So we said that when a company issues an instrument, it could be any kind of instrument, it could be debentures, it could be preference shares, it could be equity shares for that matter to begin with. So when a company issues an instrument, it is called an issuer, and it is to decide the presentation in the balance sheet. It needs to decide that is it own funds that is called equity, or is it a loan funds that is called liability. So accordingly, you would present it under the equity section of the balance sheet, or you're going to present it on the liability side of the balance sheet. And the other company which makes an investments in these instruments is called the holder, and he is going to reflect it on the asset side of the balance sheet, and typically he is going to call it as financial assets. So now let me give you two more important inputs at this stage. If the issuer says it's equity, the holder would still say it's an asset. If the issuer says it's a liability, the holder would still say it's an asset. So who is the entity which needs to decide the presentation? It is to be decided by the issuer, because irrespective he says it's equity, he says it's a financial asset. He says it's a financial liability, but he still says it's a financial asset. So in any case, the decision is not to be taken by the holder. As far as a presentation is concerned, the decision needs to be taken completely by the issuer. And another important aspect which I like to throw at this very stage itself, because that is one of the major misconceptions people have got. And trust me, I want to kill that misconception at this stage itself. Later, it creates a trouble in your mind. Let me, I think, first of all, clear one thing point blank. Many a times since we are learning financial instruments for the first time, and you must have done, accounting in 10 plus 2, you would have done your accounting in terms of your graduation and maybe in terms of intermediate, but you never got exposed to the concept of financial instruments. So what comes as a basic thought is something like this. If I say a company issued equity shares, the moment we hear the word equity shares, what comes to the mind is that this is equity. So the moment we say that a company issued equity shares, immediately it comes to mind, okay, the company issued equity shares, it is equity. If I say, for example, a company issued debentures, so what immediately comes to the mind is, okay, the company issued a debenture that is supposed to be a liability. So that's how the thought process works. That certain names of the instrument itself, starts telling you that this is equity and this is liability. Now, let me caution you, friends, at this stage. When you're going to learn the aspect of Ind AS 32, deciding the instrument is equity or liability, let me tell you point blank something very clear. The name of the instrument is absolutely irrelevant in order to decide whether it's equity or liability. I cannot say that if I borrowed money by way of a loan, I can't say it's a liability. If I say I issued equity shares, it doesn't mean that it is equity. If I issue debentures, it doesn't mean that it is supposed to be a liability. You cannot go with the name of the instrument. Let's get it very clear. This is one thing which I need to, give you as a clarification, because many of you will have reasons to believe that if we say I issued equity shares, okay, it is equity. I took a loan, it's a liability. I issued debentures, it's a liability. No, please don't go with the name of the instruments. The name of the instrument is not going to be a deciding factor. We're going to see a procedure which is given in the standard, which helps you to decide whether it is a own fund or a loan fund. The nomenclature, the name of the instrument cannot be a deciding factor. We need to basically look at the terms and conditions attached. We need to basically look at the terms and conditions which are attached to the instrument. The terms and conditions attached is going to give you whether the instrument is equity or is it a liability. And what I'm going to do today, I'm going to create a three-step model today to you. We're going to look at the definition, what is given in the standard, but I'm going to give you a three-step model with the help of which we're going to apply Index 32. And we are going to decide whether a given instrument is equity or a liability using a simple three-step model. So let me, I think, at the very first instance, also tell you something. How am I going to go about it? And today, I need your complete level of, complete level of concentrations. Because every word which I'm going to say is going to be very important in terms of developing the entire understanding of this standard. So what I'm going to do, I'm going to first of all give you a three-step model, which is going to be a version 1. And then I will slightly add more value additions, and I'll give you a three-step model, a version 2. And then I'm going to make some more value additions, and I'm going to give you a version 3. And that would be the final version. So I'm going to give you, first of all, a version 1, which will be a very basic version. But then I'll soon override it by a version number 2 after giving you some more understandings. And then I will overwrite it and I'll create a version number 3, which is going to be, the basic thing. So let's give you something like 1.0. 2.0 and 3.0. So we're going to study our three-step model in terms of deciding equity or liability in a version 1.0, in a version 2.0, and in a version 3.0. And then I'm going to make a total of almost like 4 charts with you. After the 3 versions are done, I'm going to create a total of 4 charts with you. Once you get all the 3 versions and once you get all the 4 charts, trust me, you will be in a very good position in terms of deciding when is it equity and when is it a liability. Trust me, I have not given you anything technical so far. I've just given you some basic inputs. So before I take it further, let me just quickly consolidate the learnings to you and we're going to go further. And Shankar tells me, sir, I was eagerly waiting for your 3-step model, sir. Thank you. In every standard, I've been creating 3-step model. So how could financial instruments be spared? And this is just one of the first 3-step models in the standard. You're going to see some more 3-step models coming in more as we get more deeper into this particular standard. Okay, so let me first quickly do a little consolidations of our learnings and then I'll take it further. So what you need to know so far is that when I look at financial instruments, there are a total of 3 standards. One is 32, presentation. It talks of the presentation from the issuer perspective in the balance sheet of the company. Then Ind AS 109, which is dealing with recognition and measurement, and which is one of the core standards giving you the accounting treatments in the books of both the issuer as well as the holder. And then there is Ind AS 107, which talks of disclosures to be given in the notes to accounts. I'm yet to give you the definition of financial instruments, but I've just given you one very basic inputs to begin with, and that is that a financial instrument means when a company issues an instrument, you need to basically decide that in my balance sheet, it's either equity section or it is a liability section. So the issuer, when he issues an instrument, needs to decide, is it equity or liability, own or loan funds, in simple words. But the company which makes an investment in this particular instrument is only going to decide that it appears on the asset side of the balance sheet. So the main call in terms of deciding the presentation is on the issuer, who needs to decide, is it equity or is it a liability? And for this purpose, to begin with, I've given you a very important input, and that is name of the instrument cannot be a deciding factor. I cannot say that if I issued equity shares, I cannot say it's equity. I cannot say a debenture is a liability. It is the terms and conditions, the term sheet attached to the instrument, which will be a deciding factor. So get this very clear. Name is not important, but it is the terms and condition which is going to be important. Right? I guess good enough to start. Now, let me take you to the definition of financial instruments. This is given in the study material unit number 1. And I'm just looking at the definition. And trust me, I think at this stage, you'll easily appreciate the definition with the background which I've given you so far. Now, let's have a look out here. It says a financial instrument is any contract. A financial instrument is any contract. We know a contract is always comprising of a minimum of 2 parties. So when you say a financial instrument is a contract, it is a contract between 2 parties. One is called an issuer and the other is called the holder. So when I'm looking at a contract, I'm looking at that there are going to be 2 parties in the contract. And if you ask me the 2 parties, I would say one is called the issuer and one is called the holder. So it says it is any contract that gives rise to a financial asset for one entity. So it gives rise to a financial asset for one, which is that one entity. It is supposed to be the holder. And it is a financial liability or an equity instrument of another entity. When I say another entity, it is supposed to be the issuer. So the standard gives you a very basic definition that a financial instrument is a contract between issuer and holder, where the holder would always say it's a financial asset, but the issuer needs to decide that it is a financial liability or it is an equity instrument. So I think if I were to pen down this definition to you, I would put it like this. I would pen down the definition something like this. So if I were to look at what is financial instrument, you can maybe copy this down as well. So if somebody were to tell me to, break the definition into a simple language, I would say, what is a financial instrument? I would say it is a contract. I would say it is supposed to be a contract. Now, when I say it is a contract, the question arises, is it supposed to be a written or can it be oral as well? Well, it can be oral or it can be written, because both are supposed to be enforceable under the code of law. So what is first important is the presence of a contract, and in terms of the contract, there are always 2 parties. In terms of the contract, there are always 2 parties, and I can say which are the 2 parties. We can say one is issuer and one is the holder. If somebody were to say who is a issuer, I would say issuer is the one who makes a liability side of the balance sheet, and the holder is the one who's going to make the asset side of the balance sheet. And we've already seen in this particular case, if I were to decide, if I were to look at the permutations combinations, the permutation combinations would work something like this. The issuer says it is equity instrument, or he says it is a financial liability, but the holder will always say it is a financial asset to me. That is how I would look at the definition, that a contract between the issuer and the holder, where it gives rise to either equity or financial liability for the issuer, but it is always a financial asset from the holder's perspective. So I think if you need to understand this definition in more detail, you need to basically understand three terms. You'll have to understand what is a financial asset. You need to understand what is a financial liability, and you need to understand what is an equity instrument. So if one needs a complete idea in terms of financial instruments, you need to basically understand three terms which are there in the definition. We need to understand what is a financial liability. We need to understand what is an equity instrument, and we need to understand what is a financial asset. So what I'm going to do, I will first of all explain the concept of what is a FL and what is an equity instrument. Let's keep the financial asset a little on the side right now. So my focus to begin with is I'm going to focus on what is FL and EI. We're going to talk of the holder financial asset later. Because once you know what is a financial liability, trust me, a financial asset is a mirror image of financial liability. The moment I know that this is an FL, I can just create a mirror image and say that this is a financial asset. So my focus to begin with is going to be on FL as well as equity instrument. So let's now focus on the three-step model. What is FL and what is EI? Now, let me, I think, begin the inputs to you on a step-by-step basis. Now, hear this very carefully. I'll give you the version number 1, and let's understand that what is the three-step model. So I am giving you, if you want, you can note down the version 1 as well. So I'm giving you a three-step model. I'm giving you a three-step model, and in this case, I'm giving you a version 1. I'm giving you a version number 1. As I said, I'm going to give you 3 versions, but we'll go step by step because things can be complicated. So I'm going to insert my value additions slightly in a step by step. So let's go with the version number 1. Now we go to the step number 1. We go to the step number 1. Well, the very first question you're going to put across to yourself is, does the issuer have a contractual obligation? Your first focus will always be, does the issuer have a contractual obligation? Underline the word contractual obligation. So you need to put across the very first question that does the issuer have a contractual obligation? Now, let me explain that. Let's say, for example, I need to pay income tax to the government. Is this an obligation? Yes. But is it a contractual obligation? The answer is no. I am legally obliged to pay income tax to the government. I am obliged by virtue of a law. But that law is not a contractual obligation. So when I say the obligation is contractual in nature, it is that I've entered into a contract. Either it is written or it is oral in nature. That doesn't make a difference. But what is important is the obligation has to be contractual in nature. Well, a contractual obligation is a part of a legal obligation. Now, let me tell you one thing so that no confusion comes later. Like for example, when you did Index 37, you would remember that there used to be a legal or a constructive obligation. Now, when in Index 37, we used to say a legal obligation, it was either by law, that is, there is a legislation, or it was by way of a contract. Now, let me tell you, today I am not saying that the obligation is legal. I'm only saying that the obligation has to be by contract. So if it is by law, it's not covered for financial liability or equity instrument. So if you want to bring it under the purview of Index 32, I am not saying that the obligation is by law. I'm saying that the obligation is by way of contract. So the first question you're going to put across is the obligation contractual in nature? Let's give you more example. So when I said that if I have a liability to pay taxes to the government of India, I have an obligation which is by law. It is a legal obligation by law, but I need an obligation which is contractual in nature. Let's take more example. Let's say, for example, my customer gives me advance money. My customer gives me an advance money. Do I have a contractual obligation towards my customer? Yes, I do. I definitely have a contractual obligation towards my customer because when he gave me an advance, I am contractually bound to provide him goods and services. It is an obligation which is contractual in nature. I'm only concentrating on step one. I'm only concentrating on step number one, that the moment I look at an obligation, what should trigger to the mind is that the obligation is contractual in nature. Okay, so this is one piece. Let's take more example. Let's say, for example, my company sold laptops to the customer. My company sold laptop to the customer and I gave them a warranty. I issued them a warranty obligation card. So do I have a contractual obligation towards my customer? Yes, I do. So when I get advance from the customer, when I give a warranty obligation to the customer, they're all cases where I have a contractual obligation. So even when I issue, for example, you can say debentures, I enter into a contract with the debenture holder, so I will have a contractual obligation. So your very first focus is going to be on the point that the obligation of the issuer has to be contractual in nature. I hope I'm pretty clear on that. Though I have taken some more examples, which may not ultimately, fall within my three-step model, but don't worry, we'll give you more clarity. But right now we're focusing on the step one. Okay, Manshay said, moonlighting is a contractual obligation, not by law. It's illegal in India. Well, I'm not looking at, the obligations which are illegal. We're only looking at your obligation is contractual in nature. So once you put across the very first step, your answer would be either a yes or the answer would be either a no. So you would either get the answer a yes or a no. If the answer is a no, in that case, standard is not applicable. The moment there is no contractual obligation, it cannot be FL, it cannot be equity instrument, standard not applicable. If you say a yes, I'm going to go to the step number two. As simple as that. Now watch me carefully, friends. Now watch me carefully on the step number two. Now, once you say yes, there is a contractual obligation, we go to the focus number 2 and you start looking at the mode of payment. Now, this is crucial. This is going to be very crucial. Your step number 2 needs and step number 3 needs your full attention. So in my step number 2, I'm going to go to the mode of payment. What is the mode in which the contractual obligation will be discharged? So when I say the mode of payment, it means what is the mode of payment in which the contractual obligation will be discharged. Now, let me tell you to begin with. The mode of payment as per this standard. The mode of payment as per this standard is either in terms of cash. I'm going to discharge the contractual obligation by giving the other party, the holder, cash. Or I may land up giving my own equity shares in the company. I tell the holder that in order to pay the obligations, I will give you equity shares in my company, indirectly considering my equity share as good as a currency note. Mind the words. Indirectly considering that I am going to use my equity share as good as a currency note. Either you pay the fellow by giving the cash which is, issued by Reserve Bank of India. Or you tell the person that I will use my equity shares of my company, and I'll pay the obligations in the form of my equity shares. So you can either pay cash or you can pay equity shares. Now, let me tell you at this particular stage, let's assume that this is an exhaustive. Let us assume that this is an exhaustive list of mode of payments. If you're going to give a payment in any mode other than cash or other than equity shares, standard not applicable. Let me put it point blank at this stage. If you're going to make a payment in a mode other than cash or other than equity shares, the standard is not going to be applicable. Don't worry, certain logics I'll give you later. Right now, I'm just giving you a 3-step model. I will give you some value add-ons in terms of logics also later. So let's put it like this, that if there is any other mode, if there is any other mode of payment, then let me put it point blank, the standard is not applicable because I've given you an exhaustive list of mode of payments. Let me tell you, there are 2 kinds of liabilities in life. Those which are paid in cash or those which are discharged by way of goods and service. Generally, when you pay liabilities, you may either pay liabilities by way of cash, or there may be certain liabilities which are paid by way of providing goods and services. So if you're going to make a payment, if you're going to discharge the obligation by way of goods and service, standard is not applicable. Standard is not applicable. So what is important is you should see that either you pay a cash or you pay equity shares, but it's not other than cash equity shares. If your mode of payment is goods and service, no, standard does not apply. Let me just take some more example, so that you get a complete clarity on the step number 2 as well. So let's give you some examples on the step number 1 and 2 so far. Let us make a walkthrough on 2-3 examples and see what is the step 1 and step 2 going to be. So let's have a look at step 1 and let's have a look at step number 2 and see where do we stand so far. Before we go to the step number 3, now let's put questions to ourselves. Number 1. Let's take the first example. The first example is, I received an advance from customer. I received an advance from a customer. So when I received an advance from the customer, I'm now going to put questions to myself. My customer gave me money. My customer gave me cash as an advance. Now, I need to see Do I have a contractual obligation towards the customer? Yes, I do. But what is the mode of payment in which I will discharge this obligation? Am I going to give him cash? No. Am I going to give him equity shares? No. Are you going to give him goods and services in return for the advance? Yes. So mode of payment in this case is going to be giving goods and service. So the standard is not applicable. This advance cannot be a financial liability. It cannot be an equity instrument. So then what would it be? Non-financial. In order to make it as a financial liability, the mode of payment has to be cash or equity share. If it is neither financial liability nor equity, it is undoubtedly non-financial. It is undoubtedly non-financial. So in this particular case, we can say the standard is not applicable because the mode of payment is goods and service. Though earlier, I gave you this example in step 1 only to prove that yes, I've got a contractual obligation. I may pass the step number 1, but I may fail the step number 2 on the ground that contractual obligation is there, but the mode of payment is not cash, but it is goods and service. I hope, friends, I am making complete sense. Great. Okay, Mansha, you said ESOPs. Well, we'll come to that later. No worry. It's just the beginning. You'll have a lot of questions coming in. ESOPs, I'll answer later. Don't worry. Let's take another example. Let us say I provided a warranty. I provided a warranty to my customers. I gave a warranty to my customer. Now, if I gave a warranty to my customer, do I have a contractual obligation? Undoubtedly, yes. I have entered into a contract with a customer where I told him that if anything goes wrong, I will repair, I will replace. So there is a contractual obligation. Now let's go to the step number 2 and see the mode of payment. When a company gives a warranty obligation to the customer, do you give him cash? No. Do you give him equity shares? No. What do you give him? You give him services. So what is the mode of payment going to be? You're going to give him services. And if you're going to give him services, then the standard is not applicable. And you know that when you create a provision for warranty, it triggers the concept of Ind AS 37. And you account for the provision under Ind AS 37, and that provision is a liability, but it is non-financial in nature. It's not financial. So this standard will not address the financial instrument standard, cannot address that issue. It is going to be covered with a separate standard. There is Ind AS 37. Let's take more example. The similar one which we took, let's say, for example, we said we got to pay income tax. We got to pay income tax. So when I say that I am liable to pay income tax, yes, I've got an obligation, but is it contractual in nature? The answer is no, it is not contractual in nature. In this case, it is an obligation by law. It is not by contract. Therefore, I don't need to supply the step number 2. The standard is not applicable. You know, I've created this 3-step model based on a lot of illustrations I saw in the study mat and the concepts which I saw covered through various other questions. And I decided to create this 3-step model, which is going to give you a very good insight so that the fundamentals are very clear. Let's take more example. Let's take more example before we go to the next step. Let's say, for example, I made a purchase from a supplier and it is a credit purchase. So it created a creditors, or you can say a trades payable. Let me put across the question to myself that the obligation towards the supplier, is it contractual in nature? Yes. There may not be a written agreement, but there is an oral agreement. So is it contractual obligation in nature? Yes. What's going to be the mode of payment? Generally, I'm saying generally, you're going to make a payment to your suppliers in terms of cash. So the mode of payment is generally going to be cash. And if it is going to be cash, my step number 2 is met. I guess I've given you variety. I've given you variety where step number 1 passes or fails. The step number 2 passes or fails. That's how you go to think. Right? So far, so good. I hope, friends, you are getting the entire concept so far. Okay. Any questions coming in between? Do ask me. But I guess your ESOP question is still pending. I'll come to that question later. So far, so good. Now let's come back. Now, let me add on some more things to you. Logic will be given very soon. Don't worry, logic will be given very soon. But let me now tell you something point blank. If the mode of payment is cash, it is financial liability. Sir, why? Don't worry, I will tell you the logic after I'm done with the step number 3. As of now, just accept me. If your mode of payment is cash, it is a financial liability. And if the mode of payment is equity shares, I'm going to go to the step number 3 and decide. I'm going to go to the step number 3 and decide. So I've given you the cuts in terms of step 2. If the mode of payment is cash, FL. If it is equity shares, step 3, any other mode of payment, standard is not applicable. Now let's have a look at the step number 3. So let's have a look at the step number 3 now. Now, in terms of the step number 3, we've already said that the mode of payment is equity shares. If the mode of payment was equity shares, we came to the step number 3. And in terms of step number 3, you are now going to focus on the number of shares which will be issued. The number of shares which will be issued. So I want to focus on the number of shares which will be issued. Let me explain. What do I mean by the number of shares to be issued? Let's take an example to illustrate this part to you. Let's say, for example, there is a company A Limited and there is a company B Limited, and company A took 10 lakhs from B. Let's say company A took 10 lakhs from company B. Now, I'm ignoring the interest for practical convenience. Let's not consider that there is no interest payment. Let's consider only the principal. Let's ignore the interest for understanding perspective. Now, A tells B, A Limited tells B that I've taken 10 lakhs from you. He says that I will repay this money after 5 years. Now, A tells B two things. Number 1, he says, I need to pay you this 10 lakh after 5 years, but let me tell you, my share price prevailing today. A tells B that I need to pay this 10 lakh to you after 5 years. But let me tell you that my share price prevailing today is, let's say, to the extent of 500 per share. This is the price as of today. So A tells B, let me do one thing. I have to pay you 10 lakhs divided by 500. So let me decide the number of shares which I will give you after 5 years. Let me fix the number of shares which I will give you after 5 years. Let me pre-decide and let me tell you the fixed number of shares which I will give you. Let us pre-decide today. Or the other possibility is that A tells B another possibility. He tells B, I need to pay you 10 lakh rupees after 5 years. It is not logical that I divide this by the price as of today. Let's see what is the price 5 years later. So A tells B that let me not divide it with the price today, but let me divide it with the price which will be there after 5 years. So if the price is 500, I'll divide by 500 and give you the shares. If the price is 2000, I'll divide it by 2000 and I'll give you the number of shares. So I will give you the shares which will vary according to the price after 5 years. Let's not fix it right now. Let's keep it fluctuating. So he says, I can't pre-decide the number. The number is going to be decided at a later date. So the first option would result in issue of fixed number of shares. And the other option would result in issue of variable number of shares. So in the first case, you can say A tells B that let me give you a fixed number irrespective the price is after 5 years. I know the price as of today. Let me decide the number of shares to be given to you. Let's fix it right now. And in the other case, he tells B that, okay, let's not fix the number right now. It will vary according to the price which will prevail post 5 years. So I'll divide it by the price post 5 years, and accordingly, the number would be decided. So it can vary. It's not something fixed as of now. So you are going to decide the number of shares which will be issued. We're going to decide the number of shares which will be issued. And if you say the number of shares to be issued is fixed, it is predetermined, it is going to be called as equity instrument. Sir, why? Accept me right now. I'll give you the logic. And if it is going to be a variable number of shares, then in this particular case, it's going to be financial liability. So I've given you the version 1, but I'm yet to give you a few logics as well. But I've given you the version 1. Let's quickly take a turn on the version 1. So in order to decide that a given instrument is a financial liability or it is an equity instrument from the issuer point of view, you need to apply a 3-step model. You're going to first of all put across a question: does the issuer have a contractual obligation? If you say yes, he has got a contractual obligation, you go to the step number 2 and focus on the mode of payment. Effectively, there can be only 2 modes of payments, either cash or equity shares. If the mode of payment is cash, it is FL, and if the mode of payment is equity shares, you go to the step number 3 and decide that if you're going to issue fixed number of shares, you pre-decide the number of shares, it is equity instrument. And if you give variable number of shares, then it is supposed to be financial liability. So, but we fail to understand why the mode of payment cash means FL, why a fixed share means that it is equity, and why a variable shares means NFL. Would you like to know the logic? Or do you think you've got the logic that cash should mean FL and fixed shares should mean equity? Did you get the logic, or you want me to give you a little more logic in terms of why FL and why equity instrument? Okay, I think Simarjeet says, so what if the mode of issue is, what if mode is of issue of debenture? Well, at this stage, it is too early to answer you because I am still evaluating whether debenture is equity share or a financial liability. Did you get my answer? You see, you are right now looking at, I'm deciding whether a given debenture is equity or is it a liability. So let's not talk of that. I'm going to give a mode of payment. So right now you need to accept me that a mode of payment has to be equity share. If a debenture is not an equity share, naturally you are saying that this is not a part of the mode of payment and therefore the standard is not applicable. Correct? Okay, I think Kriti tells me, yes, sir, we want a logic as well. Let's now give you a logic. I'm going to give you the logic which you have done in school as well, but somewhere or the other, it might have slipped out of our minds. And I would like to now take you back on the logic. So watch this carefully. I'm just going to take you back on school days. I remember when we were in school, we were very clearly told that there are 2 kinds of funds. One is called equity funds and one is called loan funds. Basically, we used to call them as own funds and loan funds. We know that a business always survives on 2 kinds of funds. Any business has got 2 kinds of funds. One is owner's funds and one is the loan funds. The own funds is what we technically call equity and the loan funds is what we technically call liability. And today we are calling it as financial liability. So when a company runs its business, it needs own funds equity or loan funds, that is liability in typical financial liability. Now, you would recall that there were two concepts which distinguishes what is equity and what is liability, and the two parameters are return and repayment. Remember, when we were in school, we were given the thought that if a company issues a debenture, for example, which we used to call it as a liability, what was the essence of a liability when we used to issue a debenture? We used to say, as an entity, am I liable to pay the interest? Am I liable to pay interest irrespective, even if I don't earn profits? The answer was yes. So as far as the return is concerned, you were liable to pay this interest irrespective. A company was liable to pay a return on the instrument in the form of interest, even if it doesn't earn a profit. And were you liable to make a repayment of the principal money as well? Yes. So the characteristic of a loan fund was that you are liable to pay a return every year in the form of interest. You're liable to pay the principal money back after n number of years. So you've got an obligation for both return as well as repayments. But when it came to equity funds, you were not liable to pay any dividends. Even if the company earns a profit, I was under no obligations to pay any kind of dividends to the shareholder. And even if the equity shareholder would ask me to pay money, I've got no obligation to pay the principal money back. Unless the company liquidates, the company is no longer liable to pay this money during the lifetime of the company. So there is a complete absence of return and there is a complete absence of repayment for equity, but there is a repayment and there is a return which is given to the loan funds. Now, this is something what we were told in school. Now, I want to show you another aspect of this transaction and have a look at another aspect of this transaction. Let's now look at this transaction from the point of view of a risk perspective. Have a look at this transaction from the point of view of a risk perspective, that in terms of equity, who takes a risk? Is it the issuer or is it the holder? From the point of view of a liability, who takes a risk? Is it the issuer or is it the holder? Let's watch. In terms of equity, you tell the holder, boss, I'm not liable to pay dividends. Boss, I will not repay your money even until the company liquidates. So who takes a risk in this case? Is it the risk taken by the issuing company or is it by the holder? It is the shareholder who takes a risk. So the risk is on the holder. The risk is on the holder. So when you call an instrument as equity funds, when you call the funds as equity, the risk is run by the holder. And if you look at a liability, for example, you're telling the debenture holder, I will give you interest even if I don't earn profits. I'll give you money back. I'm under an obligation to give you everything back. So the holder is not running any risk except a credit risk. Yes, he is running a credit risk that the company defaults in making him a payment, but still he has got an obligation. He's got a right to receive. The company has got an obligation to pay. They may not be able to pay the money. That's a different thing. But at the end of the day, the company is obliged to pay and the holder has got the right to receive. So the risk is completely on the issuer head. So we can say that the moment you say it is supposed to be a liability, the risk is on the issuer. So we can say that when the funds are called equity, the risk is on the holder. When the funds are called a liability, the risk is on the issuer. Now, apply the same logic and get the facts. If your mode of payment is cash, or the mode of payment is equity share, which is either fixed or it is variable, let us see who runs a risk. Let us evaluate things from the point of view of the risk and let's evaluate. If the issuer company tells the other fellow, boss, I'm going to give you cash. So the issuer is running a risk because I have to pay a cash to the other fellow. If I have to pay a cash, then who is running a risk in this case? Can I say the risk is run by the issuer? And if the risk is run by the issuer, then it's a liability. Now, if your mode of payment is equity shares, you're telling the other fellow, I will pre-decide the number of shares. I'll give you a fixed number of shares and I'll pre-decide it as of today. So the other person is willing to accept that fixed number of share, which means he's taking a risk. If the price of the share goes up, he gains. If the price of the share goes down, he loses. So if the holder is willing to accept a fixed number of shares as of today, then the risk is on the holder. When the risk is on the holder, it is supposed to be equity. It is supposed to be own funds. And similarly, if you're telling the holder, I will give you a variable number of shares, don't worry, as many shares, so that you are completely paid off. I tell him, don't worry, whatever is the value of the share at that point of time, we'll give you as many shares so that you get your 10 lakhs money back. Then who is running the risk? It is being run by the issuer. And if it is issuer, it's a liability. I hope you got the logic. So it is the risk perception which is deciding whether it is equity or whether it is, liability. We knew this in school, but I think now we're just trying to, learn it back, that when you're looking at an instrument being called as equity, it is own funds. The risk is being run by the holder. When it is a liability, the risk is being run by the issuer company. So the moment you pay in cash as a company, as an issuer, you run a risk. The moment you use even equity shares but variable, you run a risk. And when you run a risk, it is supposed to be a financial liability. And if you're giving a fixed number of shares, you're passing on the risk to the holder. And in those particular cases, it becomes an equity instrument. Right, friends, I hope I am pretty clear on my three-step model, the version 1. Okay, I think Kriti said, so mode of payment is decided in the contract? Yes. And Simarjeet says, great, sir, got it. Wonderful indeed. Now, before I take it further, friends, as you know that I've got a little usual habit just to get an assessment so that I also understand how far we've been able to sink in the version number 1. I want you to give yourself a score on a scale of 10. I want to see your comfort zone on the understanding of the version 1, the three-step model. What is your comfort zone with the logics in terms of this three-step? Then I'm going to take the journey forward. So let's get your comfort zones. And I think I would like to try a few questions, at least at this stage, though we are still on a very first version. I know it's a bit early to take you to any kind of questions at this stage, but I still want to take a risk as well. Okay, so we got some scores. Mansha 8, Simaranjeet 9.5, Kriti 8, and Tahir is 10 by 10. That's wonderful indeed. And Shankara says, so basically, if the risk is borne by the issuer, it is a financial liability. Yes. And if the risk is borne by the holder, it is an equity instrument. Yes. And now you're going to put me another question. Sir, if the risk is borne by both the people, then what are you going to call it as? Wait and watch. You're going to get the answer for that also very shortly. Because right now we've seen only two perceptions. One is in terms of risk is on the issuer, then it is FL. Risk is on the holder, it is equity. If the risk falls on both, undoubtedly it's going to be a blend of debt plus equity, that is liability plus equity combined, which we're going to see later. Okay, we got some more scores coming in. Shankar 9, Vishal is 9. Tariq sir, the logic is very interesting, wonderful indeed. And Prashant is 10. Super. Abhishek. So could you please summarize this concept in brief once again? Okay, I'll do that for you. I'll do that for everybody. Before we take you further, let's get now the consolidation with logic. So this is going to be version 1. We're going to add a version 2 after that. So first, let's do a consolidation with logics with you. Let's go back. So I've given you a 3-step model with logics as well, which will decide whether instrument is equity or whether instrument is a financial liability. And this 3-step model I have created, tailor-made, especially to consider the needs of the examination. And a lot of research has also gone into this. I tried applying this to various permutation combinations of questions, and then you get the final version. But this is version 1. And, since the lot of inputs went in, I thought I broke it down into versions so that it doesn't become too complicated to handle. Okay, let's now take it further. So you're going to put across 3 questions to yourself. In the step number 1, you need to see that from the issuer point of view, the obligation is contractual in nature. You need to see that in a given situation, does the issuer have an obligation which has to be contractual in nature, not legal? I should not be obliged by law, not by a legislation, not by a law, but I need to be obliged by way of contract. That's one. If you say no, standard not applicable. If you say yes, you go to step 2. Get in step number 2, very clear. There are 2 modes of payments. One is cash and one is equity shares. There cannot be any other mode of payment for the time being. Please accept this, that there is no other mode of payment. I've given you an exhaustive list of mode of payments. If you give a payment other than cash or other than shares, let's say you're going to give a payment by way of goods and service, standard not applicable. If you're going to give a payment in cash, you are running a risk as an issuer. If you're running the risk as an issuer, it is financial liability. If the mode of payment is equity share, you go to step number 3 and you need to see, what did you tell the other fellow? Are you going to give him a fixed number of shares, pre-decided, so that if the share price goes up, he gains, the share price goes down, he loses? So if you give a fixed number of shares, you're passing on the risk to the holder. It becomes equity instrument. And if you're going to give a variable number of shares, in those particular cases, you're still keeping a risk with you as an issuer, because you're telling him, boss, don't worry, I'll give you enough so that you get your money back. So I take a risk as an issuer, it's an effort. So the clear fact is, a contractual obligation, focus 1, mode of payment cash, FL, mode of payment shares, fixed equity, variable, FL. Done. Ready for the questions, I guess. I'm going to take you to the questions which are there in unit number 3 of the study mat. I'm carrying unit number 1 as well, and I'm carrying the unit number 3 as well. So I'm going to first of all take you to the questions in the unit number 3. So let's have a little look at the questions in unit 3. Just give me a second. I'm just going to organize a few questions. I guess this is a question which is given in the unit number 3, and there is an illustration number 13. There is an illustration number 13. I think that should be good enough to see. Yes. So I'm just going to read out the question, and we're going to apply a 3-step model. If you get your answers before me, please punch in your answers on the chat. I will be able to get your answers as well. CBA issues convertible debentures for an amount of 100 crores. The debentures are convertible after 5 years into equity shares of the company using a predetermined formula. It's not predetermined number. Please be careful with the language. It doesn't say predetermined number. It says a predetermined formula. And look at the formula carefully. If you notice in the numerator, it is 100 crores into 1 plus 10% raised to power 5. It is like an amount which is being compounded at a given rate of interest for n number of years. It's like a principal which is compounded at 10% for n number of years. So that represents a cumulative amount. And this is being divided by the fair value on the date of conversion. On the date of conversion means you are considering the fair value which is going to be after 5 years. I think the instrument is 5 years. Yes. So you are considering the fair value which will be prevailing post 5 years. Examine the nature of the instrument. I think you would have decided. Let's see if you're getting answers on that. Okay, so we got some more inputs, Kriti. So if equity shares are paid in cash, then that equity shares are considered as FL. Please don't get into too many complications at this stage. Let's go step by step. Okay, so we got the answer, Abhishek. So please summarize the logic for equity or FL also. Done that. So we got answers. FL and Kriti says equity. Abhishek says FL. Prashant FL. Mansha FL. Majority is saying FL. Kriti, you said equity. Let's get it straight. I am going to go with my 3-step model one by one. No jaldabazi. You need to go step by step so that there is no mistake. मैंने इतने प्यार से 3 स्टेप मॉडल बनाया, आप उसको उतने प्यार से लगा तो सकते हैं. क्यों जल्द करते हैं? स्पीड थ्रिल्स बट किल्स. CBA issues convertible debenture. Is there a contractual obligation? Yes. When you issued debenture, you will have a contractual obligation. Next, what is the mode of payment? It says debentures are convertible into equity share. The mode of payment is equity share. We go to the step number 3. You just need to decide the number is fixed or the number is variable. When you're dividing it by the fair value on the date of conversion, are you pre-deciding the number? Of course not. It is a variable number because the number to be given depends upon the price after 5 years. So it is a variable number of shares. And if it is a variable number of shares, then undoubtedly it becomes a financial liability in this case. Because you're going to issue variable number of equity shares, it is a financial liability. Let's read. Such a contract is a financial liability even though the entity can settle it by delivering its own equity instruments. It is not an equity instrument because the entity uses variable number of equity shares to settle the contract. The underlying thought behind the conclusion is the entity is using own equity instruments as a currency. It was a variable number, and since it's a variable number, it is undoubtedly a financial liability. I hope those who got a wrong answer got the logic. Okay, I think that was right. I got a lot of answers coming in. Tariq, Vishal, Amita, Kriti. Yes, it is FL. That is great. Let's try another one. Let's try another one before we give you the version number 2. Let's look at the illustration number 14, though I think the heading itself is going to give you the answer. It's like conversion into fixed number of equity shares. I don't think so. I need to even read the illustration. If you've followed me, what I've explained in the last 1 hour plus, you can understand conversion into fixed equity instruments will make it what? Let's still read. DF issues convertible debentures for 100 crores and the debentures are convertible after 5 years into 15 crore equity shares of 10. What is the nature of the financial instrument? He's already clearly told me that I will give you after 5 years a pre-decided number, which is 15 crores. It is a fixed number of shares. I don't think so. I need to tell you that it is an equity instrument, right? Great. Wonderful indeed. That was absolutely correct. So I think even if I apply the 3-step model, is there a contractual obligation? Yes. The mode of payment is equity shares and it is fixed in nature. It becomes equity instrument. I hope, friends, I am now clear on the version number 1. And I think it's now time to enter into the version number 2. And the version number 2 is going to enter into a little more complications at this stage. And depending upon your understanding, if I feel that giving you a version 3 at this stage is going to be dangerous, I might withhold it. Not that I'm not going to give you a version 3, but I might hold it for some time. But if I feel that it's a right time, then I might give you a version 3 as well. Otherwise, the version 3 can happen maybe in the next class on Saturday. Shani Bhari Hoga. So maybe we can give you the version 3 on that day. Wow. Let's go back now. So I'm coming back. So let me just go back and let's go to the version number 2. Let me state the version number 2 here itself. Okay, so this is done. Now let's go to the next part. We're going to give you a version number 2. Now, before I give you a version number 2, I need to first of all add some points. I need to add some points, and I'm going to add 2 points. So please hear me very carefully as I give you the 2. When I was looking at step number 1, I used the word obligation. When I was looking at the step number 1, I was looking at the word obligation. Trust me, even during a course of my other discussions, I made it clear that obligation has got 2 components. Obligations has got 2 components. One is return, which is in the form of either interest or dividends. One is a return, which is either in the form of interest or you can say a dividend, which is called a return. And the other is repayment, and the repayment is in the form of the principal component. So that is the principal component. So we can say the obligation on an instrument has got 2 components. You've got an obligation to pay a principal repayment and a return in the form of interest or dividends. Now let me ask you a very simple and a logical question. Is it possible that the mode of payment of each one of them is different? Is it possible that a company tells that I will give you the interest in cash, but I'm going to give you the principal money in terms of equity share? Possible. So there is a possibility that, a company pays them through different modes. These modes might be different. The company decides that the return will be given in cash, and the equity, the principal money is going to be paid in terms of equity share, which leads me to a very important input. And that is, when you apply my 3-step model, when you go to apply this 3-step model, I would insist that you should apply it separately for each component. You should apply it separately for each component of the obligation. I hope I'm very clear. Run this 3-step model separately. So decide that the principal component is FL or equity. Decide, is it FL or equity? And decide, is the return component FL or equity? Sir, but this could lead to different kind of permutation combination. Yes, I understood that this can lead to different permutation combination. I'll give you the permutation combination and you can help me. Are you thinking of the same lines or not? You will say that if I'm going to run the 3-step model to the principal separately, to the interest dividend separately, then there is a possibility like this. When you applied the 3-step model to return, and when you applied the 3-step model to repayment, it is possible that both are FL. It is possible that one is FL and the other is equity. Yes, sir. It is possible that both are equity. Both are equity. So these are the different permutation combinations which can come, that this is FL and that is FL. If it is FL plus FL, the instrument overall is FL. If it is FL plus EI, then it is called CFI, compound financial instrument. So if you know that one of the component of the instrument is FL, another component of the instrument is equity, then FL plus equity makes it a compound financial instrument. It's blended. And if it is EI plus EI, then it is EI. So the nature of this instrument could be something like this. I hope you got the point. So when you're going to look at now the question, if you remember the two questions which I did right now, we were not given a separate detail about repayment of principal and return. He very clearly said the principal with a 10% interest compounded will be given in the form of share. So there was only a common mode of payment. Both the principal and the return was paid in one component mode of payment. But there is a possibility that each and every component of the obligation is paid in different modes. And if it is paid in different modes of payment, then in that particular case, you need to be careful that if it is FL for one, FL for another, FL. If it is equity for one, equity for another, equity. And if it is FL for one, but equity for another, then it is called CFI, compound financial instrument. Did you get the first stage of the inputs? Shankar sir couldn't even see how time passed with the class. Is that interesting? Thank you, Shankar. That's very sweet of you. Even I didn't realize that we are almost around 1.5 hours through. And trust me, this is such an interesting topic, and I love this topic so much indeed that you're going to see that, even 10 classes will pass by. We'll still feel that there is more to say and there is more to learn in this topic. It's such a fascinating topic. And there is so much, inputs in this particular standard that it's a beautiful standard in the chapter. Okay, so this is one inputs I've given you. So you need to keep this one input in mind. So this, I'm not going to write it as a part of my version 2, but this is something implied. So in my version 2 now, I'm going to take care that I need to run the 3-step model separately for each component of the obligation. Now, let's give you another point number 2 before we come to the version number 2. Now, friends, I'm going to overwrite what I said. Now, you're going to find this crazy, but trust me, I'm going to basically, overwrite what I said. Earlier in step number 2, I said that if the mode of payment is cash, we said it is a financial liability. But now I'm saying, please don't decide like this. If the mode of payment is in cash, it does not mean that it is a financial liability. It needs a further assessment. You need to do a further assessment now, which I did not give you in the version number 1, but I'm adding this in the version number 2. So from now onwards, when you're going to look at a question, if I say the mode of payment is cash, and if you notice, I've been smart. I did 2 questions with you, and in both the questions, the mode of payment was shares and not cash. I didn't do a single question with you where the mode of payment is being cash. Smart, no? Intentionally did questions where the mode of payment was equity shares, and I did 2 questions with you. So now I'm saying that if the mode of payment is cash, don't call it as a financial liability. You need to consider a further assessment. Now, what is that further assessment? Let's watch. What is that further assessment? Let's watch. Now, as we said, that there are 2 components of the obligation. There are 2 components of the obligation. One of the components is what we said, return. the interest or the dividend. And the other component is what we call the repayment of the principal money. The repayment of the principal money. So when you're looking in terms of the further assessment, you need to be watchful that there is return, one component of the obligation, and there is principal repayment. Now, the examiner is going to use certain words. Like, for example, when it comes to return, he will say the return is mandatory. Or it will say the return is discretionary. They will start using the word that it is mandatory, or they will start using the word it is discretionary. So till now, we have not seen that questions, but now when he says that the company is got to pay interest or dividend, it'll say it is either mandatory. Mandatory means you've got an unavoidable obligation to pay. When I say mandatory, it means unavoidable obligation to pay. An unavoidable obligation to pay would mean financial liability. When it says discretionary, it is avoidable obligation. Meri marzi. If it is discretionary, that means you have got avoidable obligation. Avoidable obligation is equity. So when you're going to look at the interest payment, he might use the word mandatory, discretionary. Let me ask you something. Let's say, for example, a company issues a preference share with a cumulative dividend. Do you think it is mandatory or it is discretionary? A company says, I'm going to issue the preference shares with a cumulative dividend. So cumulative dividend means that if you're not able to pay this year, due to the absence of profits, it's going to be carried forward and paid in the next year when you're going to earn profits. So do you think it is mandatory or is it discretionary? What do you say in this particular case? That if you're looking at a situation, a company says preference shares with a cumulative dividend, and that's rightly said, it is undoubtedly mandatory in nature. So you got to read the language of the question very carefully, and you need to decide that even though the mode of payment is cash, you need to see, is it mandatory or is it discretionary, and accordingly decide. Now let's have a look in terms of the repayment of the principal. For principal, he cannot use the word mandatory or discretionary. Rather, he's going to use the words called redeemable. He's going to use the words called redeemable, or we're going to use the word irredeemable. Or we're going to use the word irredeemable, and you can easily decide. If I say it is redeemable, that means I am mandated to redeem it after an n number of years for sure. So in this particular case, when you say redeemable, it is a financial liability, and if it is irredeemable, later I might make some changes, but for the time being, it is equity instrument. I might make some changes later, but for the time being, if it is irredeemable, I'm going to call it as equity instrument. So now onwards, when you say the mode of payment is cash, I will say, okay, let me see which component are you talking of. If you're talking of the interest and dividend, is it mandatory or discretionary? And if you're looking in terms of the repayment, is it redeemable, irredeemable? I will call it as an FL only if there is an unavoidable obligation to pay. I put it again. I'm going to call the component as FL only if there is an unavoidable obligation to pay. If you've got an unavoidable obligation, whether it's a return or it's a principal, it is FL. Avoidable obligations to pay are not considered as FL, even though the mode of payment is cash. But what is important is that you will pay cash or not. If you're obliged to pay cash, undoubtedly, then it is FL. If you say, if I give cash, that's not FL, that's equity. Right, friends, I hope I'm clear on my second agenda as well. So far, so good on that. Great. So we are ready to make a version number 2. I'm ready to make a version number 2 notes to you based on what I've given you. So let's give you the version 2. So what do we do with the version number 1? Throw it in the dustbin? You can. Except that you can keep that version number 1, because when you're going to make your revisions, you're going to get your learnings on a step-by-step basis, so you can keep that. But of course, I am giving you the version number 2. So let's give you the 3-step model, that is the version number, the 3-step model, the version number 2. So this is version number 2. You can put it as 2.0 as well. I'm calling it as version 2. You can put that as 1.0, 2.0, whatever. But let's have the version number 2. So in this particular case, if I go on the step number 1, there is no change. So I'm keeping it same as version 1. I'm not putting it again. So it is same as the version number 1. So there are no changes in terms of step 1. You're going to see the same thing, that there is a contractual obligation. If you say a yes, you go to the step number 2. If you say a no, standard is not applicable. Okay. Let's have a look now to the step number 2, what changes I have done. Basically, I've done changes only to step number 2. And before that, I think I'll also like to give a clarification, lest we forget, that when I'm going to look at this 3-step model, let's put it out here. Please apply 3-step model. Please apply 3-step model to each component, of obligation separately. So this is the crucial point which you need to keep now, that you need to apply the 3-step model to each component. And you know which is the each component. So in terms of each component, the focus is the return, interest and dividends, and the principal. So you got to apply this on the interest, return, and the principal separately. Now, that is one thing which you need to keep in mind. Okay, now coming to the step number 2. So the changes in terms of step number 2, you got to see the mode of payment, which I said undoubtedly is exhaustive. So we've got an exhaustive mode of payments, and we're looking in terms of cash and the mode of payment in terms of equity shares. If it is equity shares, you go to the step number 3. If it is equity shares, same as step number 3. But if it is cash, you got to make assessment. Don't say financial liability. You got to make an assessment. And your assessment, I've given you the terminologies you need to watch out. So I'm just going to insert this table out here. I'm going to insert this table out here. So I think let's put that table in short out here. So when you're going to look at the assessment, you're going to look at the assessment as far as return, look at the words. As far as repayment, look at the words. So I'll put it in short. You already have the details. You're going to see mandatory or discretionary. If it is mandatory, then it is FL. If it is discretionary, equity instrument. And for the principal component, if it is supposed to be redeemable, it is FL. If it is irredeemable, then it is equity instrument. So this is what is there. And step 3 remains the same. So as far as the step number 3 is concerned, it is same as version 1. No changes, same as the version number 1. Okay, so the main changes I've done that you got to apply the three-step model for each component separate and assessment chart for the cash angle. Wow, that's interesting indeed. I think now I just want to conduct a small little permutation combinations, because before we go to the version number 3, I just need to get a little more comfortable zone before we go to the version number 3. Okay, let's see if there is any questions coming so far. And Shruti sir, why version 2 and 3, sir? In version number 3, I'm going to add something more in terms of the step number 3. Version 2, I change step 2. Version 3, I change step 3. Therefore, I called version 2 because step 2 changes. Version 3, step 3 changes. Therefore, version 1, version 2, version 3. Okay, so that's how just going to help you out. Okay, I think maybe we can try some questions before we go further. Let's I think first give you one or two combinations of my own before we go to some questions in the study mat and before we introduce you to the concept of a version 3. Okay, let me first add a few inputs to you. Try this out, friends. I want you to try this out based on your learnings out here. Let's say a company issued convertible debentures. A company issued convertible debentures and they said, we will pay the interest in cash, which is mandatory, and the principal amount will be converted into equity shares, which is pre-decided and it is fixed in number. Try this. A company issued a convertible debenture where they said the interest is in one mode, cash, which is mandatory, and the principal is in another mode, which is fixed shares. Let's see, how do we get the answers out here? Abhishek, sir, amazing personality you are, sir. Thank you so much, Abhishek. You make my day. Shruti, sir, what's the logic that if mandatory, it's FL and redeemable, it is FL? Okay. Well, the logic is that if it is mandatory, what does FL means? That you've got an unavoidable obligation to pay. So when you see the presence of unavoidable obligation, I have to pay cash. So there is an unavoidable obligation, then it is FL. If it is an avoidable obligation, then it's not a financial liability, then it's equity. You can avoid the obligation until redemption, until I would say liquidation of the business, right? Okay, so we got the answer. And Tariq, you said, so how do you remember all such complex things in a structured manner? God gifted. And I think it's been a lot of inputs. I've gone through these things for a couple of many years and all. And therefore, there is so much into the blood. I think I'm going to take a DNA test and, I'm going to find India's DNA into it. Okay, so we got one answer from Amita. Let's get more answers. There is a cash which is mandatory and there is a principal which is fixed in number. Decide. I want you all to decide, friends, and get the results. What is the nature of the instrument? Apply the three-step model, make a walkthrough in terms of component 1, make the walkthrough in component 2 based on the version 2, get your results. Thank you, Vera. And we got the answer. That's correct. We got another answer, compound financial instruments. Great. That's right, Kriti. That was right, Amita. Let's get some more answers. Friends, from you. I need to get that comfort zone that you are getting the step-by-step approach. And that's right, Prashant. That's right, Mansha. Absolutely. That's right, Tariq. And Abhishek, sir, I'm still stuck and confused at the step. Will you explain the risk criteria? Why is it a risk for the issuer and in case of a loan? Okay. Let me put it like this. Let me just take you back before I answer that so that there is no confusion. Let me just come back to what I was telling you at the beginning. Let's, I think, have a look at this. You see, I need to understand one thing. When a company prepares a balance sheet, it says equity and liability. This is where I got the money. Now, I'll tell you something further, which I didn't say, but I think it'll help you to understand the logics further. When a equity shareholder gives a money to the company, he says, you keep this money and I don't want any return back from you. You earn profits. You're not liable to pay dividends. You are not liable to pay this money back. What does he want in return? He says you grow this company and the market price of the share increases. So he's wanting more return from the company. So he says, I don't want anything from you. So what the equity shareholder does, he puts the money into the company. The company grows in such a way that the market price of the share goes up. Any day, the equity shareholder wants to realize his money. What he's supposed to do, he will sell the equity shares in the open market and he would be able to get realized return. He takes a huge risk. The equity shareholder takes a huge risk and he says to the company, you keep this money. I don't want anything from you. Whenever I need money, I'll go to the stock exchange, but you're indirectly going to create history on the stock exchange. So he's willing to take a huge risk in order to get a huge return. So he doesn't expect anything directly from the company, but he gets an indirect expectations by increasing the market price of the share, which may or may not increase. I give the money to the company as an equity holder with expectations that the prices might increase, but it may or may not eventually increase. So as a holder, I am taking a risk. When I'm taking a risk, in this particular case, in my balance sheet as a company, I will say, boss, I am not obliged to give you anything in life. You are the owner, the malik of this company. Malik company se paisa मांगने थोड़ी आएगा. Got the point? So in this particular case, when the risk is taken by the owner, the Malik, then in that case, it is equity. So what sits on the balance sheet as equity is the owner who bears the risk without getting a direct reward from the company. But then there are certain people who say, we are not taking a risk. So when you present the balance sheet of the company, you tell the world at large that these are the people, equity holders, they will get their returns indirectly from somewhere else in life. And they've got huge scope of getting returns, unlimited. And these are the people who don't want to take a risk and they funded my company because they don't want to take a risk. I hope you got a point right. I hope I'm clear. Okay, so now I think let me come back. I was on the example which I asked you. So let me answer that part now. I think I got the answers correct. Okay, Kriti said, can there be combinations of equity instrument as well? Combinations in what sense? I didn't get that. Okay, now when I say the mode of payment is cash and it is mandatory, it is unavoidable, financial liability. When you say the principal is equity shares and it is fixed in number, it is equity instrument, FL plus equity instrument makes it a compound financial instrument. Got it now, Abhishek? Great, wonderful indeed. So that is how we decide the assessment. So my version number 2 is done, but I still need to do a little practice. I'm not very sure whether I should take a chance of giving you a version 3 today. You tell me yes or no. Because version 3 is going to be very heavy, but I think in any case, what I'm going to do, I'm going to do first a bit practice with you on a few questions based on the version number 2, and do let me know if you're comfortable, if your mind is not getting too stretched, then I can add on the version number 3 as well. But I'm a little skeptical. I don't know. You can give me your inputs on that. But I think at this stage, let's first give you a break. I'm sure you need one. So let's, I think, first give you a break. In the break, in meantime, do give me your inputs, whether you're ready for a version 3 or you want me to take that version 3 later, then we can do something different. Okay. And Shruti says, sir, inquisitive for the version number 3. Okay. Anyway, let's do one thing. Let's first give you a break. And this is almost like 7:45. So 10 to 12 minutes break, friends. We'll see you in around 12 minutes time. Relax your minds. I'm going to see you back. Welcome back, friends. So I hope you had a relaxation of mind. And okay, I'm getting some inputs. Yes, sir, we are ready for this. Let's first do some questions. So please give it today. It seems to be very interesting. And okay. So let's, I think, first do some practice questions with you. And then maybe let's make some comprehensive charts as well, because I gave you that 3 versions and I've got a total of 4 charts. But I think at least we're ready to give you 3 charts today to at least consolidate the learnings. So first, I think we'll do some practice with you. Then I'm going to make some charts, and then we are going to go to the next part. So let me just take you to a few illustrations in unit number 3 back again. Here we have on the unit number 3, I'm looking at the illustration number 1. Try not to read the answer and give me your inputs as we read. So please keep sending your answer on the chat box. I'm just going to read the inputs to you. It says A issues preference shares to B. A is the issuer and B is the holder. It says the preference shares are redeemable at the end of 10 years from the date of issue. And then he says entitles the holder to a cumulative dividend of 15% per annum. The rate of dividend is commensurate with the credit risk profile of the issuer. Examine the nature of the instrument. I don't think so. I need to tell you anything. I think you can easily decide. The instrument, the preference shares, is redeemable. That's one. And it has got a cumulative dividend at the rate of 15%. So you got to apply your 3-step model to the 2 components separately, look at the dividend, which is cumulative in nature, and decide, and look at the principal component, which is redeemable. Nowhere I'm given in the question the mode of payment is equity shares. So I would definitely assume the mode of payment is cash unless mentioned otherwise. So I think let's see if we have got some answers right now. Very good. I think I got the answer from Tariq right away. I guess we'll get some more answers as well. That's absolutely correct. It is undoubtedly a financial liability. That's correct. Okay. So in this particular case, when I say it is redeemable, the principal component is FL. And when I say the dividend is cumulative in nature, it indicates it's mandatory, and that is also FL. So both the components are FL, and my equation becomes that FL plus FL is equal to financial liability. Now, I think just let's have a little read as well. It says the instrument provides for a mandatory dividend and a redemption by the issuer for a fixed amount at a fixed future date, since there is a contractual obligation to deliver cash for both the dividends and the repayment of the principal. It says the preference shareholders that cannot be avoided. It says there is an obligation to deliver cash which cannot be avoided. As I said, it's an unavoidable obligation. The instrument is a financial liability in its entirety. I think you would have understood every word of the solution as well. So very clearly, you apply your 3-step model. Tell the examiner there is a contractual obligation. 1, tell the examiner the mode of payment is cash, and tell him that in terms of the dividend, it is mandatory. In terms of the principal, it is redeemable. So there is an unavoidable obligation to pay cash, which means it is undoubtedly a financial liability. Great. That was wonderful indeed. I think we got absolutely correct answers. Great. Let's have a look at more questions as well. So this is all questions picked up from the unit number 3. I'm now looking at the illustration number 2 in the unit number 3. It says X company issues debentures to Y. X is the issuer and Y is the holder. The debentures are redeemable at the end of 10 years from the date of issue. The interest is payable at the discretion of the issuer. I don't think so. I need to say anything further. The debentures are redeemable, so the principal is redeemable and the interest, the return is at the discretion. The rate of interest is commensurate with the credit risk profile of the issuer. What is the nature of the instrument? I think you can now decide. Redeemable principal and a discretionary interest in nature. Let's see what is the answer we are getting. Apply your minds and think of what is the nature of this instrument. Let's see. I'm pretty confident that I'm going to get good number of answers on that. So it's a redeemable instrument as far as the principal is concerned and discretionary interest is concerned. Okay, maybe the answers is coming slow. So I think I should answer. Redeemable in nature means it is FL. And discretionary interest means it's equity. And I think you would have decided, yes, I got the correct answer. It is supposed to be a compound financial instruments. Wow, we got flooded answers this time. Brilliant. Superb. So we can say one component is FL, another component is equity instrument. So the instrument becomes a compound financial instrument in this case. Now, there is another crucial question which is coming to the mind, that when I am going to call this as a CFI, how would I present this instrument in the balance sheet of the company? No worries, after the illustrations, I'll come to that point as well. It says the instrument has got two components. One is a mandatory redemption, and it says the interest which is at the discretion. The first component is a contractual obligation to deliver cash, and that cannot be avoided. So this component is a financial liability. Then he says the second component of the interest is discretion of the issuer, hence will be classified as equity. Then he says this is also discussed in detail in the compound financial instruments, but we know that one component is FL, another component is equity. That makes it a compound financial instrument. Brilliant indeed. Okay, Kriti sir, this type of questions can also come in the exams. Well, less likely. This is just a base in terms of what we're going to do in the standard. Less likely that you're going to get questions of this sort in the exam. But now considering that you're going to get around 30% MCQs in the exam, then I think this kind of questions can definitely trigger up. So far, in the previous old version of the course, there were no MCQs, so we used to get only bigger kind of questions. So these kind of questions were not there. But now considering, an MCQ, you'll definitely be tested on these grounds as well. Okay, let's go to the next one now. So let's go to illustration 3. It says P company takes a loan from Q and the loan is perpetual. Perpetual means it is supposed to be irredeemable in nature. And then it says it entitles the holder to a fixed interest of 8% per annum. Examine the nature of this instrument. So it says that there is a loan amount, the principal is perpetual, irredeemable, and there is a fixed interest at the rate of 8%. So when you say there is a fixed 8%, it means you got to pay 8% irrespective. It is something which is unavoidable, mandatory in nature. But the principal at the same time is something which is perpetual in nature. Okay, now let's see. I don't know if I should discuss this at this stage or not. And Abhishek sir, are they going to be case scenario based MCQs as well? Yes. You can get MCQ case study based. You can get direct single MCQs. Yes. Okay, now I think let me explain this part because there is something more which I need to tell you, though I think which I'll be telling you maybe later, not at this stage. Let's see. The instrument has got two components. One is a mandatory interest, which is definitely FL, and one is a perpetual nature of the principal amount. And the first component is a contractual obligation to deliver cash, and that cannot be avoided. This component is FL. If you would have noticed something, yes, you rightly said that it is supposed to be a CFI. But if you notice something in the answer, you know what the answer has been given. The focus is only telling you about one of the components, which is the fixed interest, and the study is being a little silent on the fact whether this particular perpetual loan is supposed to be equity or not. Because this illustration comes again later when in the study material they've done a discussion on a compound financial instrument. Now, I would like to now give you some insights at this particular stage, but for this purpose, we need to understand the concept of time value of money, or maybe we can do it later. I think this time it might get a little more technical. Let's forget it for the time being, but I need to discuss something. I will be discussing something very shortly today only later. Don't worry, I'll be discussing something more on a perpetual loan something later. So right now, let's consider that this is a CFI. Okay, now let me just give you another clarification as well, which is a part of the illustration 4. If a company is got a contractual obligation to pay, but it is unable to pay, mind the words carefully. If a company has got a contractual obligation to pay, but it has got inability to pay, it does not negate the fact that it is not a financial liability. So if the company has got a contractual obligation to pay, so you're saying it's an FL, even if I say that the company has got inability to pay, there is lack of funds or there is restrictions, legal restrictions on the part of the company to pay that money, it does not negate the fact that it's not a financial liability. There is an illustration 4 which says, does the lack of access to foreign currency or the need to obtain approval for payment of a regulatory authority will lead to a contractual obligation? And the standard makes it very clear. Lack of access to foreign currency or the need to obtain approval from regulatory authority does not negate the entity's contractual obligation or the holder's right to get the money. So what we are looking at in terms of classifying the instrument as a financial liability is you have got a contractual obligation to pay. Your inability to pay that contractual obligation would not make any difference on the assessment part. Okay, so far, so good. Okay, I think let's consider one more question with you. So I'm going to consider another small little question with you. Illustration number 5. Then you can practice the rest of the question. Let's have a look at the illustration number 5. Though I think this is a little dangerous to discuss. No, we're not discussing illustration 5. Don't even try this illustration at this moment. Leave it. Now what I'm going to do, I'm going to first create some charts to you. So before we go to the version number 3, we need to discuss some charts with you. So we're going to first consolidate learnings, and then I'm going to add a few things to you. So let me just make some charts. Okay, so let's get ready to make some charts before we discuss anything further. Now, there are 2 things which are pending at my end. I need to discuss the concept of perpetual loan, which I'm going to do this after the chart. Then I need to introduce you to the version number 3. So before I introduce the version 3, I'll be discussing something which is relating to a perpetual loan. So first, let's give you some charts. So I'm going to make some mind maps in the form of charts, which will consolidate our learning so far, so that we are absolutely crystal clear till this point, and then I can add variations. So I'm giving you a chart number 1. My chart number 1 is based on the fact that the mode of payment is cash only. So I'm making my chart number 1, which is based on the fact that the mode of payment is cash only. So I would also advise, if you want to get more grippings on things, do one thing. Once I'm done with all the 4 charts, right now 3, you could do one thing, sit down and do your practice from the study material and see which illustration relates to which chart. So you will be able to revise it better. That part I'll leave it to you. So let me now give you some permutation combinations, and you can decide. If you want, you can give your answers as well on the chat. I'm going to give you some permutations combination. So I'm looking at a return which is in the form of interest or dividend. I'm looking at the repayment. I'm looking at the repayment which is in the form of principal. And I'm looking at the nature of the instrument. I'll give you permutation combination. You can note it down as well. So let's look at the permutation combinations. Number 1, I'm looking at a mandatory return, and I'm looking at redeemable. I'm looking at redeemable instrument. So when I say it's a mandatory return, FL, when I say it's redeemable principal, then also it is supposed to be FL. So I think let's get this very clear, that when I say mandatory, it is FL. When I say it's redeemable, it is FL. So I can put it for your clarification, FL plus FL, both the components are FL, and it becomes a financial liability. So if you want, you can keep giving your answers as well. Otherwise, I'm making the chart. Next, I'm considering another combination. It is mandatory. It is mandatory and it is irredeemable in nature. I'm saying it is mandatory and it is irredeemable in nature. This, of course, is FL. And for the time being, what we've understood, it is supposed to be equity. So we can say it is FL plus equity, and that is going to be called as a CFI. It is a compound financial instrument. So one of the components is FL and another component is equity. So a blend of FL plus equity makes it CFI. Great. Next, I'm going to consider discretionary. Next, I'm considering it is discretionary and it is redeemable in nature. So we can very clearly see in this case, discretionary means it is equity and redeemable means it is FL. So we can say it is equity plus FL, and that makes it equal to CFI again. So we can say discretionary is equity and redeemable is FL. So one component FL, another is equity, makes it a CFI. Next, let's consider the combination for it is discretionary. It is discretionary and it is irredeemable in nature. I think if I apply this concept, then we can clearly see discretionary means it is equity, irredeemable means it is again equity. So equity plus equity, that makes it equal to equity instrument. Right. So I think these are the combinations, and trust me, if you look at all the permutation combination, this is an exhaustive permutation combinations if the mode of payment is cash. If you notice something, what I did, I took mandatory return with a combination of redeemable, irredeemable. I took a discretionary return with a combination of redeemable, irredeemable, and trust me, there cannot be any permutation combination. So this is my chart number one. When the mode of payment is only cash, whether it is the return, interest or dividend, or whether it is a principal, these are all the permutations combination. I guess so far so good. Chart number one is done. Let's create another chart. So let's go to this chart number two. I'm going to create a second chart now. So let's have a look at the chart number two. And in the chart number two, I am considering the mode of payment to be equity shares only. I'm considering the mode of payment to be equity shares only. That's the focus point, that now I'm going to consider the principal as well as the return. Both are paid only in the form of equity shares. So to my mind, I guess there are going to be only two permutation combinations. I guess to my mind, there are only going to be two permutation combinations, and you can decide as well. So you would consider the principal compounded at a given rate of interest for n number of years, and this is divided by the fair value on the date of issue. This is divided by the fair value on the date of issue. Try this out. So I'm considering the principal which is compounded at a given rate of interest for n number of years. So this is the total lump sum amount to be paid, and I'm going to divide it by the fair value as of today to decide the number today, which is predetermined, which is fixed in number. So can I say in this case, you are going to give a fixed number of shares? And if it is a fixed number of shares, it is undoubtedly an equity instrument. And that's right. That's right, Abhishek. Next, let's consider, we're considering the principal compounded at a given rate of interest for n number of years, and we divide this by the fair value on the date of conversion. On the date of conversion. So I'm dividing this by the fair value on the date of conversion. So this is going to give you a variable number of shares, because you will decide the number to be given at a later date, which is variable in nature. So this will give you a variable number. And if this is going to give you a variable number of shares, then it is undoubtedly a financial liability. Super. I think these are the only two combinations. I think in chart number two, there cannot be a third combination, because when the mode of payment is only and only equity shares, you land up issuing either fixed or you land up issuing a variable shares. So it is either an FL or it is an equity instrument. Okay, that's great. Let's create another chart number three. Let's create a chart number three as well. And in terms of the chart number three, I am considering the mode of payment, let's say, to be cash and equity shares both. Let's consider this to be cash and equity shares both. So the focus out here is the mode of payment is both cash and equity shares. Now let's get ready. If you're able to answer all these inputs, then I think your concepts are going very good. Let's create a chart. So I'm going to consider now different permutations combination. I'm considering the return and the principal, and I'm going to consider different forms of payments for both of them. So let's consider the return, which is in the form of interest or dividend, is going to be paid in cash. And let's say the repayment, which is the principal amount. Let's say the repayment, which is the principal amount, is going to be paid in the form of equity shares. Let's get this straight. Shankar, the charts are very useful. That's what I'm making it, so that, before the exams, You look at the crux and you're able to get everything on grip. And let's consider the nature of the instrument as well. So watch this out carefully. Try to answer the questions. The return, which is interest or dividend, is cash. The principal repayment is shares, and we're deciding the nature of the instrument. Let's begin with the combination number one. Let's say the return is mandatory, and let's say the repayment is in terms of variable number of shares. I guess you can decide if it is mandatory, it is FL, and if it is variable number of shares, it is FL. So we can say FL plus FL, the overall instrument becomes FL. So we can clearly see mandatory is FL, variable is FL, both the components FL, that makes it FL. Next, let's consider the combination. It is mandatory, and let's consider it is fixed. I guess you can decide again easily. So this is FL mandatory, and this is equity because it is fixed. So it is FL plus equity. So one component is FL, another is equity. That makes it CFI. Wonderful indeed. That's going great. Let's take the combination number 3 and let's consider discretionary. Let's consider discretionary and let's consider variable in number. You can see the combinations which I'm creating is created with a complete permutation combinations in hand. Discretionary means equity, variable means FL. So it is equity plus FL, and that makes it again a CFI. Wow. And I think the only fourth combination possible which is coming in is again discretionary. It is discretionary and it is fixed in number. I think let's get this last one from you. So let's get this last one from you. Discretionary return with a fixed number of shares to be given on the principal makes it what? Okay, so third one was CFI. That was right. Let's get the fourth one from all of you. Discretionary dividends or return and discretionary fixed number of shares makes it what? Let's get this from you. Okay, maybe the net is a little slow, so we're getting some answers. We'll get a huge number of answers in one go. Okay, I got the answers and it was absolutely correct, all of you. Wonderful indeed. It is equity plus equity is equal to an equity instrument. Great. This was, consolidating all the learnings in the form of 3 charts to you, the 2 versions and the 3 charts done with the logics. Now, I need to do a little rectification, and the rectification which is required is in chart number 1. I need to make a little rectification which I'm going to explain to you. So I'll tell you what am I going to do at this stage. I need to now give you an understanding of this part. I need to give you an understanding of this part. I need to clarify this part to you. Everything is perfect. Everything is perfect except this particular combination. Now, friends, hear me carefully. As I explain a clarification to the instrument which is mandatory return and it is irredeemable in nature, let me explain. So I'm going to, before I take to the version number 3, I need to explain you something. Now, this is very necessary because I'm going to speak something more on what I'm saying right now in the coming classes as well. So please hear me very carefully. Let's say, for example, my company, I borrowed, let's say 10 lakh. Let's say, for example, I borrowed 10 lakh. I'm taking you to a bit on Ind AS 109, but it is necessary in order to understand a concept. So I'm pushing myself to Ind AS 109 just to give you an understanding. And I'll be speaking of this, what I'm saying right now, later on as well. Let's say my company borrowed 10 lakh. Now, if I were to put an entry, the entry is bank account debit, and this is the amount I received. And let's say if I classify this as a liability, let's say if I classify this as a liability, the amount which you are going to calculate, the amount which you're going to calculate as a liability is not what you receive, is not what you receive. My liability is not equal to 10 lakh. My liability is not what I receive. My liability is what I will pay in the future. So the standard says you need to record a liability at a fair value. And when you calculate a fair value, you need to consider the present value of future cash outflow. So which means when I'm going to consider the liability, I will calculate the present value of future cash outflows. I will consider the present value of future cash outflows. Hear this very carefully, friends, because this concept will give you a lot of things for the future standard. So when you raise money by way of a liability, the bank is debited with the amount you receive today. But the loan, the liability is not to be given a credit equal to the amount you receive today, but it is supposed to be the present value of all the future cash outflows. Of all the future cash outflows. So let's consider I borrowed this money, let's say at the rate of 10% per annum. This was the rate at which the money is borrowed. So let's say this is the money, the rate at which the money is borrowed. Now, when I borrowed this money at 10%, and let's say the period of this loan is 5 years. So I told the other fellow that, okay, you give me 10 lakh rupees, I will pay you interest for the next 5 years at the rate of 10%, and I will repay the principal money back at the end of 5th year. So what is my present value of future cash outflow? I'm going to pay 1 lakh rupees interest for the next 5 years. So I need to discount it. And I will discount this at the market rate of interest. Let's assume the market rate of interest is 10% itself. Let us assume the market rate of interest is 10%. This 10% is supposed to be contracted rate. This is the contracted rate, but let's assume that this is also equal to the market rate itself. So I entered into the contract to pay a rate of interest which is equal to the market rate itself. So when you go to calculate the present value of outflow, you go to consider the present value at the market rate, not the contracted rate, though in this example it is same. So if I calculate at 10%, what is my PVIFA at 10%? I think it is 3.791. If you were to calculate at 10%, a PVIFA for a period of 5 years, it comes to 3.791. And then I will repay this 10 lakh rupees at the end of the 5th year. And I guess the present value factor, if you were to calculate at 10%, 5th year end, it comes to 0.621. So I will consider the present value of the interest and the present value of the principal and discount it at 10%. Let's see. This comes to 6.21 for the principal and 3.791 for the interest. And this comes to 10 lakh itself. Wow. This comes to 10 lakh itself. So which means since the contracted rate and the market rate is same, mind it, since the contracted rate and the market rate is same, the present value of what you pay and the amount which you receive is same. Because I have entered into a transaction at market terms. Did you notice in all the questions, there was something written that the interest rate is commensurate with the risk profile of the issuer? If you recall, in so many illustrations, it was given that the interest rate is commensurate with the risk profile of the issuer. He was trying to tell you that the contracted rate and the market rate is same. Because the rate at which I've contracted, I would have entered into the contract on the market at the same terms itself. So if your rate, contracted rate and market rate is same, trust me, the entry on the debit and the credit side will be equal. This was more to give you a little of financial management. It is also simply, you can see it in terms of FM like this. You're going to compound at 10%. That's what you contracted. And you're going to discount at 10. So your outflows are at 10%, you're compounding at 10, and then you're discounting at 10. So the rate at which you compound and the rate at which you discount is same. Naturally, the present value and the initial amount is got to match. I hope, friends, this maths is clear. Kriti, sir, your way of teaching Indians are very excellent in terms of three-step model of basic technical concepts and also step-by-step understanding like this in Indians as version 1 to 3. Thank you so much, Kriti. It is indeed so good of you. Thank you so much. But I hope, friends, you've understood this part so far. You've understood this part so far. Now, if you've understood this part, I am now going to change that chart number 1, the item which I gave you, I'm now going to change this. See what I'm going to do. Let me come back. Let me come back on the chart number 1. And this is mandatory and irredeemable in nature. Now, please watch this carefully. Please watch this carefully. When you look at a compound financial instrument, when you look at a compound financial instruments, we're going to see later that this 10 lakh is the amount received and the present value will be less than 10. Only then a balancing figure will arise, which is going to be called as equity. I'll be explaining it also differently in the next class. But right now, let me tell you, for an instrument to be a compound financial instrument, the amount received is 10. The liability, which is the present value, is going to be below 10. Only then you get a balancing figure, which represents an equity element in the instrument. In a compound financial instruments, we will basically segregate out of the total money, 10 lakh. What is the financial liability element? And then there is a balancing figure which will arise, and that balancing figure is going to be called as an equity component. Now, I'm going to ask you a question. Let me get the answers from your side. I know this has got slightly technical, but let me still ask you something and vouch me. I'm now going to ask you a simple question. Please vouch me carefully. A company issued a perpetual debt instrument. A company issued a perpetual debt instrument, let's say for 100 rupee. The contracted rate is 10% and the market rate is also 10%. Please watch this very carefully. Please watch this very carefully as I proceed. A company issued a perpetual debt which is 100, contracted rate is 10 and the market rate is 10. I put the entry bank account debit with the amount received. And I want to calculate my financial liability. The financial liability is not what I receive. The financial liability is what I will pay. And I will keep paying interest at 10% forever. I will keep paying interest at the rate of 10% forever. This is like annuity which is paid till perpetuity. Because if you're going to pay that 10% forever, it's like annuity. The same amount is going to be paid year by year. And if you want to calculate the present value of annuity, it is A by R. If you want to calculate the present value of annuity, it is called A by R. The annuity, which is the annual amount, is divided by R to get the present value of annuity till perpetuity. So in my example, the annuity is 10 rupee and the discounting rate is 10% market rate. Because when I consider the liability, I will consider the discounting at market rate. So whatever is the contractual outflow, 10%, discounted at 10%, and when you take 10 divided by 10%, it is 100. You do not get a balancing figure. You do not get a balancing figure, which means this instrument is FL. Since there is no equity component, it is not a CFI. It is supposed to be FL. I hope you're getting the point. Now, let me do the other variations as well. Let us say in the same example, the contracted rate is 10%, but the market rate is 12%. The contracted rate is 10 and the market rate is 12. So what is the annuity you're going to pay every year? 10. Now let's look at the entry for this one. So you put the entry bank account debit, which is what you receive. The financial liability element which you're going to credit is the present value of the annuity which you pay till perpetuity. So 10 rupees you're going to pay discounted at the market rate of 12. Discounted at the market rate of 12. So if you take 10 and divided by 12%, let's see what is the present value of this annuity till perpetuity. It is 83 approximately. You are getting a balancing figure which is called equity. Then it becomes compound financial instrument. So can you please put this all once again? This was too technical to digest. Don't worry. I'm going to put this once again to you. I know this was technical to digest. And Abhishek tells me, so this is indeed heavy. That's why I didn't take the version 3. But I wanted to do the discussion on this. Let me just consolidate the picture once again. Now watch this very carefully, that you know what is a case of a compound financial instrument. Watch this very carefully. I want to consider, one inputs which I've explained. Let me consolidate this. I think, consolidate this. You need to understand one very important element, which I'll be elaborating further in the coming classes as well. When we were in school and college, we understood one simple little thing, and that was bank account debit, loan account credit, and the debits and credits are same. We always learned one thing in school, that if you raise money by way of a loan, the entry is bank debit and the loan gets a credit. The debit and credit is same amount. And we used to put that entry with the amount received. Trust me. You always used to put the entry with the amount received. Bank debit 10, liability loan credit 10, and you used to put this amount with the same amount debits and credit. I'm now changing your perception. I'm saying when you take a loan, the bank gets a debit with the amount received. Debit what comes in. And when you give a credit to the loan, that is a financial liability, it is not the amount received. It is the present value of the future outflows. So the bank is with the amount received and the loan is with the present value of the future outflow. So you need to get it very clear that when I say liability, liability is not the amount received. Liability is the present value of the future contractual outflow. That is one thing which you need to keep in mind. So let's say, for example, I entered into a deal with someone where I said, I'll pay you 10% rate of interest and the market rate and the contracted rate is same. The market rate is 10, the contracted rate is 10. So we are saying that the rate of interest is 10% itself. So in this particular case, when you calculate the present value of the future outflows, you're going to calculate the present value using a discount rate, which is not contracted, but market rate. It is not contracted, but it is market rate. And if it is a market rate and contracted rate is same, trust me, the present value of what you pay will always be equal to 10. If you're going to pay at market terms and you're going to discount at market terms, so what you received, you will refund each and every penny back. I took 10 lakh from somebody today and I'm going to pay him interest and the principal. At the end of the day, the present value of whatever I pay him should be equal to what I took from him today. That's how we can say the transaction is at pure market terms. I hope I'm making sense. So this is financial management. That your liability is the present value of all the future outflows discounted at the market rate of interest. In my example, it was intentionally kept equal to the contracted rate. Moral of the story. If the contracted rate and the market rate is same, if the contracted rate and the market rate is same, in those particular cases, you will notice that the figure in the bank account and the figure in the loan account, the financial liability will match. And there will be no balancing figure in the entry. Trust me, when it is going to be a compound financial instrument, the bank figure has to be more and the loan figure has to be less. Otherwise, it cannot be a compound financial instrument for sure. We'll be talking of this more in detail, but remember one thing, if you're contracted and the market rate is same, the entry bank debit amount received and the entry loan credit present value of future outflow is same, it is a financial liability. And I took another example. If the contracted rate is 10 and the market rate is 12. Now don't tell me, sir, the contracted rate is 12 and the market rate is 10. Why would I take a loan at 12 if the market rate is 10? Right? So somebody might agree to give me a loan which is below the market rates. So in those particular cases, if the deal gets structured in such a way that the contracted rate is below compared to the market terms, so what will happen? The bank gets a debit at 100 amount received and the loan gets a credit at a lesser than 100 because it is a present value based on 12%. So you're going to get a balancing figure that is an equity component and therefore it proves it is a CFI. So moral of the story, and that is, if I say there is a mandatory return, I'm only talking of case number 2. If you say it's a mandatory return and it is irredeemable, don't call it as a CFI. So what is the analysis you need to do? What is the analysis you need to do now from today onwards? I will say, is the contracted rate equal to the market rate? If yes, it is a financial liability. Even though it is irredeemable. Sir, but how? A perpetual debt instrument means that you're telling the other fellow, let's continuously renew the loan. I'll keep paying you interest. You continuously do auto renewal of the loan. So which means the other person agreed that don't worry, don't pay me the principal right now. It's an auto renewal. So if it is an auto renewal, irredeemable is just a word. So in those particular cases, when you say it is perpetual, when you say it is perpetual in nature, so this is going to be typically applicable for a loan when it uses the word perpetual. So a perpetual loan, as the standard says, is supposed to be that the principal is getting auto-renewed to be paid later. So you want to compare, is the contracted rate and market rate same? FL. And if the contracted rate is less than the market rate, then it is CFI. Then it is CFI. So that was really very, very heavy indeed, but I hope you've got the point. Did you understand the concept, friends? Let me get your inputs at this stage. Did you understand the concept of bank is given a debit with amount received? Loan is given a credit with the present value of future outflow. If the contracted and the market rate is same, the amount of bank and loan is same, that makes it FL. But if the contracted and market rate is not the same, then the bank gets a debit with a different figure, the loan gets a credit with a different figure. There is going to be a difference called equity, and it becomes a CFI. So what you need to watch out in a perpetual instrument is the CR contracted rate equal to MR, the market rate, or not? If yes, FL. If no, then it is CFI. Okay, and Tariq, you said, so it is creditworthiness responsible for the contracted rate? Indirectly, yes. You know, if you notice in many of the questions we've read, that considering the credit risk profile of the issuer, this rate of interest is commensurate. Right? Okay. Great insight, clear, wonderful indeed. Now, let's take it further. A last issue of discussion. I'm not discussing the version 3, but there is one more issue which needs attention at this stage. Easy point. We're not going to the tougher one. I just need to give you one last piece of information, and then we are done with version 1. So today what I've given you is a 3-step model where 2 versions are given, and I've given you 3 charts, but I've also given you a good clarification on a perpetual loan, which can be an FL or which can be on a CFI. That's the only case where you need to watch out. Now, I'm ultimately looking at the presentation. I'm ultimately looking at the presentation in the balance sheet. Because at the end of the day, when you're studying Index 32, the focus is what? The focus is the presentation in the balance sheet of the issuer. Now, watch this. So let's consider this is the balance sheet. Now, watch this carefully. This is the balance sheet extract of the issuer. So we've got the equity and liabilities, and this is the amount. And now today what we have decided is that issuer is going to say that there are 3 kinds of instrument. Either it is FL, or it is equity instrument, or it is a CFI. Now, we're going to see the presentations here in the Schedule 3 balance sheet. You take equity, and there is equity share capital, and there is other equity, and then there is liabilities, and in the liabilities, you've got financial liabilities, borrowings. This is how the extract of the Schedule 3 balance sheet looks like. This is how the Schedule 3 balance sheet in terms of the Division 2 looks like. Now watch this carefully. Have a look out here. Now, when you say that the instrument is equity instrument, when you say the company issued a pure equity instrument, it's equity share capital. So you're going to present it out here. When you say it's a pure financial liability, it's going to be called as a borrowings. So if a company issues an instrument which is called as FL, it is a part of the financial liability borrowings presentation in the balance sheet. If the company says it is equity instrument, it comes out here. Now careful. Now careful. If you say the instrument is a compound financial instrument, the liability element will be presented in borrowings and the equity element will be presented in other equity. The equity element is going to be presented in the other equity, which is going to be a part of the SOKI statement. If you remember, I gave you that there are 3 tabs in SOKI, which I'll be discussing further in the coming classes as well. But this is going to be represented as a part of the SOKI equity component of a compound financial instrument. We are yet to learn in detail how to segregate the total money in terms of equity FL. We got a little flair today. We got a very basic flair today, and I showed you how did I calculate the balancing figure, which is equity, but we'll see more in detail. So if you issue a pure equity instrument, it is equity share capital. If it is FL, it is borrowings. If it is a CFI, the equity element enters in other equity, the liability element enters in financial liability. Son, it has got very heavy in the last half an hour, 45 minutes. Things have become heavy. That's the reason I decided not to give you the version 3, because that needs to be explained more with a fresh mind altogether. But trust me, as we are going to go further deep into financial instruments, as I started today, I told you I need a cumulative revisions on your side. Day 1 done, you got to revise. Then day 2 done, you got to revise day 1, day 2, because there are a lot of other things which will get interconnected. And your clarity of the previous class will help you to keep understanding as we go ahead. Maybe what I discussed in the last area might have been a bit technical, and there might have been still some concerns in understanding that issue, but don't worry, as I'm going to go forward, you will be able to get the connect of my discussions today. Because there is a lot of interconnectivity which is coming in as far as my further discussions are concerned. So what I've given you for the day is, let's give you a little quick mind map before we close. So let me just give you a basic inputs of the learnings for the day. So you got to, first of all, understand the 3-step model, where I gave you a version 1, which I've already overruled by the version number 2. And based on this version number 2, I gave you a total of 3 charts. So this is what you need to understand, the version 2 and the 3 charts on version 2. Then what I did, I gave you the inputs in terms of this 3 charts. I gave you a clarification on chart number 1. And I said, if you look at a perpetual loan, I gave you a clarification that if you look at a perpetual loan, the initial thought was that it is a CFI, but I said, now you need to consider the contracted rate versus the market rate. If you say they are equal, it is FL. If you say they're not equal, it turns out to be CFI. That's what I've done. Given you a clarification on the perpetual loan in the chart number 1. And along with this, I've given you the presentations as well. For all the charts based on this, I've given you the presentation in the balance sheet. How would you present the instrument in the balance sheet of the company? That's it. Maybe this part was slightly technical, but don't get worried. The logics will become furthermore clear as we go ahead. Okay, this is quite enough, I think, to digest. And I think my friends tell me crystal clear, wonderful. Satish tells me, so when CR is less than MR, I think holder bears the risk of receiving less interest component than the market rate because of the holder, and therefore it gives rise to equity. Your thought is absolutely correct. Abhishek, a perpetual debt instrument is a financial liability if it's not redeemable. CR is equal to MR, but why, sir? That is not payable anyhow. I'll tell you a story. I remember a guy working for me was from a village. And I used to ask him, what is the rate of interest you take a loan? He says the rate of interest I pay is supposed to be 4% per month. Trust me, he used to tell me I pay on 100 4 rupees every month. So it comes to 4% per annum per month. It comes to 48% per annum, as good as 50% per annum. And in that particular case, within 2 years, he used to, land up paying the entire principal. The loan holder, considering his credit risk profile, used to charge him interest in such a way that principal and interest was getting recovered through the interest itself. I hope you got it. Okay. Vishal tells me, sir, Shani aaj bhi bhari ho gaya. Saturday thoda aur bhari hoga. Pretty clear. Thank you so much. That's great. And Abhishek, sir, how can perpetual loan is financial liability not understandable? Okay, I think that question gets answered now. But don't get worried. But as I told you, that if a company knows in the market that it's an irredeemable loan, a perpetual loan, don't consider a perpetual loan that you're never going to pay a principal. As I said, the standard setters consider it's an auto renewal. The loan is getting renewed, the principal is getting renewed, but then indirectly the interest is being paid on market terms, considering the feature of the instrument. Right? More to come on that. Don't get worried on that. Just revise what we've done today, and we're going to get on more clarities in the next class. Thanks, Tariq. Thank you. Thanks a lot indeed. And thank you, all of that, friends. I think that's quite enough for the day. So we're going to catch you on Saturday. But please do your revisions. I'm going to introduce the version 3 on Saturday and take the journey forward. So thank you, all of you, once again. Bye-bye and take care.